If you're approaching retirement or you've just left your job, you're probably wondering what to do with your old 401k. It's one of the biggest pieces of your retirement picture, and making the wrong move could cost you thousands of dollars in taxes, fees, and missed opportunities. In today's video, I'm breaking down your 4 options, the pros and cons of each, and a few advanced strategies to help save you a few bucks. Whether you're retiring for good or you're just switching jobs, this guide will help you make an informed decision. And before we get started, my name's Ryan Knoll. I'm a financial planner and founder of NAV Wealth Partners, a financial planning firm that helps clients nationwide make smart money decisions. Let's jump to the video. All right, so when you have an old 401k and you've just left your employer, whether it's for retirement or it's just because you're taking a new job somewhere else, you typically have 4 options. The first option you have is you can cash it out. And cashing it out is not the best option because you're likely going to trigger a taxable event. If you're under 59.5, you're also going to trigger a 10% penalty unless you meet certain exceptions. And we'll talk about that a little bit later on in the video. But while this is an option, it's not one that I highly recommend a client would take when they're leaving an employer. The next option is you can just leave it in the current plan. You might want to consider doing this if you have a good current plan at your old employer. Something that has, low fees and a lot of investment options would be a strong consideration for leaving the plan. We'll dive more into the nuance of it a little bit later on in the video as well. You can also roll it over into your new employer's plan. And you might want to do this just to simplify your life. If you want to have one 401k plan from all of your previous employers, rolling it from your old plans into the current plan is a great way to streamline your overall investment portfolio if you're looking for that optimal efficiency route. The last option is you can roll it to a 401k, or you could roll it to an IRA. And that it would make sense if you're at retirement and want even bigger investment option, even bigger array of investment options, or if you're not doing backdoor Roth IRA conversions, assuming you're still working, that would trigger a pro-rata rule by utilizing the IRA. So we'll go into more detail on all of these options, but here are the 4 main options you have when you leave your employer: cashing it out, leaving it in your old 401k plan, rolling it to your new plan, or rolling it to an IRA outside of the workplace ERISA rules. We're going to dive into this a little bit later on. The first option you have is just to simply cash out your 401k. And why you might consider this option is if you just need quick access to cash, or you simply just don't want to worry about the old account. Now, there are a few reasons as to why this is a bad idea, namely the first one, which is taxes and penalties. If you're under 59.5, the IRS is going to slap a 10% early withdrawal penalty on that distribution, as well as your federal and state income taxes. So somebody who's in the 32% marginal tax bracket and pulls out $100,000 is paying $32,000 in federal income tax. Now, if that same person's under 59.5, they're going to pay an additional 10% on that distribution, or $10,000. So you can see they've almost eaten up half of their distribution through taxes and penalties. With more efficient planning, we can spread out that tax burden and avoid that penalty. You also lose out on compound growth. So let's say you have like 20 years left to work and there's $50,000 in an old 401k currently. If you earn, 7-8% a year on that money, that there's a good chance that over the next 20 years before you need it, that's going to grow to be worth $250,000 or more. We don't want to miss out on that future growth. And also, this is essentially just stealing from your future self and it could potentially delay your retirement. So cashing out does make sense in certain situations. So specifically, if you're in a financial emergency, like avoiding a bankruptcy, for instance, or if your 401k balance is super low, typically under $1,000 or $2,000, some companies might force you to take that cash anyways as a forced distribution. Now, you still can complete a 60-day rollover if you don't need it in that instance, but it's just something to be aware of if you've worked for a company for a short period of time and haven't accumulated a large balance in that 401k plan. Now, there are also some scenarios in which you can tap that old 401k to avoid that 10% penalty, and I just want you to be aware of them in case this is one of the reasons you're planning on cashing out your 401k early. The first is disability. If you become totally and permanently disabled, you can withdraw from your 401k without penalty. If you have medical expenses in excess of 7.5% of your AGI, you can withdraw that amount, the excess amount, penalty-free. If you're planning on expanding your family through a natural birth or adoption, you can withdraw $5,000 within 1 year of that birth or adoption occurring. The fourth is substantially equal periodic payments, or the 72T rule. You can take penalty-free withdrawals if you commit to a series of equal payments based on IRS rules until 59.5 or for a period of at least 5 years, whichever is longer. If you're a military reservist, you're qualified to take out distributions. If you're on active duty for at least 180 days, those distributions will be penalty free. In the year in which an account holder passes away, their beneficiaries can withdraw the funds without penalty. The seventh is an IRS tax levy. If the IRS places a levy on your 401k for unpaid taxes, the penalty is waived in that instance. It's one of the rare instances in which the IRS will let you take money out in order to pay them and not give you an extra penalty for doing so. The eighth is separation from service, also known as the age of 55 rule. If you leave your job in or after the year you turn 55, or 50 for certain public safety workers, you can withdraw from your current 401k penalty free. The ninth is disaster relief withdrawals. In federally declared disasters, special provisions sometimes allow penalty-free withdrawals. And then the 10th is buying a home. $10,000 can be used for the first-time home purchase without triggering the 10% penalty. So while I do recommend not taking your old 401k and just cashing it out and going on a spending spree, especially if you're under 59 and a half, there are some instances in which it might make sense. More often than not, you are going to want to keep that money invested and working hard for you unless you have some very unfortunate circumstances occurring in your life that are going to predicate a withdrawal. Let's talk a little bit about your next option now, which is just leaving your 401k in your old employer's plan. If you like the investment options, the plan is low cost, and you're not ready to make a decision yet, leaving it could be a totally fine option for you to take. You still retain tax deferral and can roll it over if needed. However, this option does come with some trade-offs. You're limited to the plan's investment menu, which is typically a conglomeration of 30 to 50 different mutual funds that you could pick from. There may be hidden record keeping and administrative fees now that you're no longer an employee. It might be harder for you to manage if you have multiple 401ks from previously leaving other jobs in the past. And some plans can be relatively clunky when it comes to withdrawals, rebalancing, or Roth conversions. So while it's convenient, it's not always an ideal long-term solution, especially in retirement when you want control, flexibility, and efficiency of your overall retirement portfolio. There are some pros and cons to leaving it in your old employer's plan that I do want to go over. So on the pro side, there's no taxes or penalties. Your money stays invested. It keeps growing, and that money is compounded by the beauty of compound interest year after year, and you still retain tax deferral. You also have familiar investment options, which if you feel that you have a good plan that has many good investment options, then leaving it there could be a perfectly viable strategy until you hit that retirement age. The cons of leaving it in your old employer plan is you can't contribute to it anymore. There may be higher fees now that you're not an employee. They may charge you like a premium in order to keep that money invested there. It's typically not a huge fee, but it's just something to be cognizant of. And it can be harder to manage. The more plans that you have, if you have multiple 401ks, it becomes harder and harder to manage that and create a portfolio that's working optimally for you. I typically advise my clients that it makes sense to leave the money in your old employer's plan when you don't need it, your new job does not have an ability for it to accept rollovers into the plan, and moving it to an IRA does not yet make sense for you. This is a plan that you're familiar with, and leaving the money there will not create a taxable event for you while still allowing your funds to grow tax-free. And when you're ultimately able to roll it over, it's a better time for you to roll over. A simple phone call to the plan provider could get that ball rolling. So this is a great option for anyone who does not currently need the money, or it does not make sense to roll it to an IRA, or doesn't have the ability to roll it into their new employer's plan. Now let's move on to your third option with your old 401k. It could be as simple as moving it into your new employer's plan. If you're changing job and your new employer allows what's called a roll-in, you could transfer that old 401k balance into the new one. And the big upside here is consolidation. Fewer accounts to manage and your full retirement balance stays in one place. But be careful. Your new plan may have limited or expensive investment options compared to the old plan, and you lose flexibility compared to an IRA and potentially your old employer plan depending on how it's set up. That said, if you want to preserve certain 401k advantages, like early withdrawal exceptions or the ability to delay required minimum distributions in retirement, this could be a strategic move that we're going to touch on a little bit later. Before we go any further, be sure to subscribe and hit that like button if you're finding this content valuable. Now let's go over the final of the four options, rolling the money into an IRA. And really what this does is it gives you maximum control over your money. With an IRA, you can invest in virtually anything: stocks, bonds, ETFs, mutual funds, index funds, cryptocurrency, real estate, you name it, you could probably do it within your IRA. You can choose your provider, a company like Fidelity, Schwab, or Vanguard, or the financial planner that you want to work with, and use their custodian in order to house those funds. And you just basically simplify your financial life by consolidating accounts. Most rollovers are tax-free as long as pre-tax 401k dollars go into traditional IRAs and Roth 401k dollars go into Roth IRAs. Just make sure you do what's called a direct rollover. And this is just where the funds go directly from your 401k to the IRA custodian. This avoids taxes or an early withdrawal penalty. This is the route most retirees take, and for good reason. It gives you flexibility, visibility, and often a better investment experience. Now, if you are planning to roll over your traditional 401k to a traditional IRA, there is one thing you need to be aware of. If you find yourself in the situation where you're making backdoor Roth IRA conversions from a traditional IRA to a Roth IRA via non-deductible contributions, you may be triggering something called the pro-rata rule if you do choose to move your 401k into a traditional IRA. Now, I have a video that goes over in depth what the pro-rata rule is, and I would suggest taking a look at it. But what I'm going to do is I'm going to draw you a quick picture to make sure you understand what it is here and that you're not making the same mistake moving forward. So let's say that we have an investor, and this investor, they want to contribute $7,000 a year as a non-deductible contribution to a traditional IRA, and they're going to go and convert that to a Roth IRA. Now, if there's no deductible balance in their traditional IRA at this point in time, this is a tax-free transaction. But let's walk through an example where they move over $63,000 from their traditional 401k into a traditional IRA. So they have $63,000, and they're going to say that's a rollover, and that's a deductible balance. And this is really important because this deductible balance is going to trigger the pro-rata rule. So what the pro-rata rule says, and we're going to go down here, so we have a little bit more room to write, is that we're going to take the prorated amount of your deductible and non-deductible contributions and apply it to that conversion. So in this instance, we know that we have $7K non-deductible plus $63K that is deductible, or a $70,000 total balance. Now, the pro-rata rule says that of that balance, 10% is tax-free. The other 90% is taxable. So when we go and we do the conversion from the traditional IRA to the Roth IRA via that backdoor conversion that we've been doing for years and years and years that wasn't triggering the pro-rata rule, it is now triggering that pro-rata rule. So when this individual goes and makes the $7,000 backdoor Roth conversion, we're going to go Roth. What ends up happening is of that $7,000, $6,300 or 90% is taxed as ordinary income, and the other $700 is tax free. So what you see here is that because this individual rolled that traditional balance and it was a deductible balance from the 401k into the IRA, we're triggering this pro-rata rule. So what happens is when they do this backdoor Roth conversion, they're claiming an extra $6,300 in taxable income. Now, for somebody in the 32% tax bracket, that's nearly $2,000 of additional income, or of income taxes rather, they're going to have to pay during the course of the year. And if they're under 59.5, they're also going to pay a 10% penalty of $630 on that. So they just increased their tax liability by about $2,500 by making a simple mistake. And that's the idea here. This is some of the nuance that you don't typically look for when you're doing these rollovers, or most advisors or planners aren't going through with you. So just make sure you're not making this mistake, because I have seen it cost clients who did it before we were working together, cost them literally $25,000, $30,000 in additional taxes over a 10-year period in which they were doing this because no one told them otherwise. What this basically boils down to is 5 key considerations. The first is fees. Understanding the fee structure of your current 401k, your old 401k, or an IRA will go a long way in helping you choose the most cost-effective method of investing this money moving forward. The second consideration is investment options. 401ks have limited options that differ across plans, as opposed to IRAs where there's a bigger, basically the entire investment universe in which you can invest those dollars. Third is ease of use. IRAs generally offer better platforms, fewer hoops, and simpler management. Now, if you have a great 401k plan that is really user-friendly, this may be a better alternative than utilizing your old 401k or an IRA. The fourth consideration is consolidation. Don't let your retirement be scattered across many accounts. Typically, when we see clients who have more than 2 or 3 old 401ks, we urge them to start consolidating it either into their current 401k plan or to an IRA, just to help them keep track of the money a little bit easier. And the fifth is coordination. If you have multiple accounts, brokerage, Roth, traditional IRAs, traditional 401ks, Roth 401ks, keeping everything in one place can help with portfolio design and withdrawal strategies. That's really what you get when you start working with a financial planner. And that's really something that I impress upon clients as they near retirement, is we want to start consolidating these in one place so I can help coordinate a better strategy overall for my clients, which are going to ultimately save you dollars in the long run. Now I just want to touch on some advanced planning strategies, and this is where nuance matters a lot. Let's walk through a few planning opportunities that can impact your taxes and your withdrawal strategy. The first is the Roth 401k versus Roth IRA debate. If you roll a Roth 401k into a Roth IRA, make sure you understand the 5-year rule. You need to have a Roth IRA open for 5 years before tax-free earnings can be withdrawn. If you've never opened one, rolling your Roth 401k into a Roth IRA will start that clock. The second is net unrealized appreciation, or NUA. If you own company stock inside of your 401k plan, there may be a unique opportunity to pay long-term capital gains taxes on the appreciated portion of that stock as opposed to ordinary income tax. This only works with employer stock, and the strategy must be executed carefully. If NUA applies to you, get professional guidance before rolling over, because it can literally save you tens of thousands of dollars. The third is the age of 55 rule. If you leave your job in the year you turn 55 or older, you can take penalty-free withdrawals from your 401k, even though the general age for penalty-free withdrawals is 59 and a half. This is a key reason to consider leaving some funds in your 401k if you plan to retire early. The fourth and final advanced strategy is the still working exception. If you're still employed past the age of 73 and you don't own more than 5% of your company, you may be able to delay required minimum distributions from your current 401k. This does not apply to IRAs, and it's another reason why someone working later in life may want to keep funds in a workplace plan as opposed to rolling it over to a self-directed or an IRA that a financial planner is managing for you. One often overlooked area of leaving an employer in an old 401k plan is whether you took a loan against that 401k while you were an employee there. So sometimes when you leave a job, you may have to consider what to do with a 401k you took a loan against. And this loan could have been for any reason: sending a child to school, buying a home, covering medical expenses, among many other reasons. But what happens if you leave the job and still have a 401k loan? Well, there are a few different things that might apply. The first is you usually have to repay it relatively quickly. Most employer-sponsored 401k plans require you to repay the full loan balance within a short period of time after leaving, typically 30 to 90 days depending on plan rules. If you don't repay it, it will become taxable income. The remaining balance is treated as a withdrawal, meaning that you'll owe income taxes at both the federal and state level, and if you're under 59.5, you're also going to have the 10% early withdrawal penalty, unless you qualify for one of the exemptions I mentioned earlier in the video. Your loan terms and rules depend on your employer's plan. Some plans are going to allow loan repayment after leaving the company, but many do not. Always check with your plan administrator before you leave your company if you do have a loan balance against your 401k. What's the best move and what I typically recommend telling my clients to do? If you're planning to leave your job and you do have that loan, repay it before you leave. Because more often than not, that's the only option other than realizing it as taxable income for the year, further inflating your federal taxes owed, your state taxes owed, and potentially paying a 10% penalty on top of all of that. So now you're all wondering, what's the best thing you can do? And the best choice for one person might not be the right choice for someone else. Here are general rules of thumb that I follow with all of my clients. If you're retired and want more control and simpler management, consider rolling it into an IRA. If you're still working and your current employer offers great investment options, consider transferring it to that 401k first. If you're retiring in between the ages of 55 and 59.5, leaving some funds in your current 401k could help you avoid early withdrawal penalties. Finally, if you're still working and making backdoor Roth IRA contributions, avoid a traditional IRA rollover at all costs. Managing your old 401k the right way as you leave an employer to join a new one or at retirement isn't just about avoiding mistakes. It's about unlocking more freedom, flexibility, and peace of mind as you step into a new chapter of life. If you're not sure which option makes the most sense for you, let's talk. Visit the link in the description to learn more about how we help clients simplify retirement decisions and maximize their income. Thank you so much for watching, and as always, I'll see you in the next video.